If you've ever sold due to fear, only to watch the price reverse right after, this video is about you. I know it's not because you're weak, it's not because you're stupid, and it's definitely not because you're unlucky. What you experienced is called FUD, fear, uncertainty, and doubt. And once you understand FUD, it loses most of its power over you. There's a specific kind of pain it creates, not just losing money, but selling because you felt you had to, and then watching the market do exactly the opposite of what you feared. That pain isn't just financial, it's emotional. You tell yourself, I'll never fall for that again. In fact, I will not look at the market again. But somehow, you still end up checking the market the moment a major news hits. I was once in your shoes. Back in February 2021, the crypto market was booming. Altcoins were surging everywhere. I came across a post on social media promoting an altcoin and urging people to buy immediately, claiming it could do a 5x within hours. I rushed to buy. Not because I had a solid plan, not because I understood the chart. I bought it because I wanted to double my portfolio so that I can use half to invest in other projects. Now, barely 30 minutes after I bought the token, the price started dropping. One red candle, then another. And within an hour, the token was down more than 20%. At that moment, I was sweating, thinking about how the money that I worked hard for weeks to earn was vanishing. That's when FUD took over. Fear replaced excitement. Uncertainty replaced confidence. Doubt took control of my decisions. I couldn't bear the pressure of watching my portfolio continue to decline, so I sold at a loss. And what happened next was even more painful to watch than the previous pain. When I woke up the next morning, the first thing I checked was the market. I was hoping the token might have crashed by 50% so that I could prove that I made the best decision. But I saw the opposite. The market had stabilized, and the price was back to where I initially bought it. You could picture the regret, the blame, the pain. But in the midst of the pain were thoughts like, should I buy it again? Should I walk away? Too many questions kept playing in my mind. But in all, I learned something, which was market behavior. I didn't just lose money, I learned how markets behave. That was the first time I truly understood market timing and the real power of FUD. I didn't buy early. I bought it late because I didn't understand the charts. I didn't understand technical analysis and indicators. What I was thinking was how to double my money, and at the end, I panicked and sold at the worst time. That experience is exactly what FUD looks like in real life. Most people think FUD is bad news, Twitter posts, headlines, or influencers screaming, "Crash!" That's not what FUD really is. FUD is what happens inside your mind when uncertainty gets too comfortable. For example, imagine you are at a phone store trying to buy the latest phone. The seller tells you the price today is good, as there is an ongoing promo, but you hesitate. You start wondering if another store might be selling it cheaper. Now, while you are contemplating, someone else walks up and says, "The manager said the promo will end today." At that moment, your mindset changes. You now have an urgent decision to make, whether to take advantage of the promo and buy at a lower price. You're no longer thinking clearly. You feel pressure to decide fast. If you buy at that moment, you're not buying because you want to. You're buying because you're afraid of losing the opportunity. That fear pushes you into a rushed decision. That feeling, that pressure to act without clarity, that is FUD. In essence, it is not the news that made you to buy or sell. It is not the tweets. It is your need for certainty that does. And that uncertainty is what makes millions of people to panic and sell at the worst time. The human brain is configured to hate uncertainty. Instead, your brain would rather accept a bad outcome or no outcome. So when price drops fast and nothing feels clear anymore, your brain looks for one thing: relief. And that relief creates a dangerous belief. A belief that says, if I could just feel more confident, I wouldn't panic next time. That belief leads us to the next question, the biggest lie about FUD. One of the biggest lies people believe is this: if I just had more confidence, I wouldn't panic sell. Well, it sounds right, but it's not true. Confidence disappears when the market becomes uncertain. When prices drop fast and fear spreads, even confident people feel pressure. So confidence is not the solution. The real solution is understanding how the market behaves. It's learning how to read charts, Understanding basic technical analysis, knowing when the market is driven by fear and when it's driven by greed. And most importantly, having patience and discipline. Patience to wait instead of rushing. Discipline to follow a plan instead of emotions. When you understand these things, you stop reacting to emotions and start making calmer, better decisions. At this point, you might be wondering what kind of market situations trigger FUD. So let's look at one. Let's look at a market scenario that triggered FUD and led to panic selling. In January 2026, the US president announced a new tariff on some European countries over the Greenland issue. Within minutes, the crypto and stock markets reacted. Price starts dropping faster than normal. Red candles stack up. At first, you're calm. Your mind tells you that it's just a pullback. Now, after a few hours, you check again, and your portfolio has dropped from 10% to 20%. You log in on social media, and you start seeing tweets of people saying that the market will drop further. Everyone is bearish. Everyone has an explanation. Almost everyone has turned to a market analyst. Some people start quoting events of the past and how the market took months to recover. Some say that the market will continue crashing for the coming days. A popular ex-analyst says that the market has dropped below the support zone and that things might get worse in the coming days. At that point, you start thinking, what if this goes to zero? What if this time is different? What if I'm being stupid holding this? At that moment, selling feels safe. But here's the trap. Feelings are loudest right before the worst decisions are made. Now, when the pressure becomes too much, you rush to sell. You sell at a loss just to make the pain stop. And in that moment, it feels like the right decision. But then something strange often happens. Immediately you sell, the market stops dropping. The market stabilizes, and the price begins to move back up. That leads us to another important question. Why does panic selling often happen near the bottom? If you are following the market, one thing you will observe is that most panic selling doesn't happen at the top. It doesn't even happen in the middle. It happens after damage is already done. Why? Because fear doesn't peak when the price starts falling. Fear peaks when people feel trapped. When the market starts dropping, your mind tells you that it will rebound soon. That hope of rebound keeps you going. You keep believing and hoping for a rebound. At a stage, your mind starts to sound different. You begin to ask, what if this doesn't rebound soon? By the time you feel desperate enough to sell, most people are already scared and selling too. And markets don't turn when people feel confident. They turn when fear runs out. Not because the market is evil, but because crowds move together. In essence, by the time you make up the decision to sell, the market is close to the bottom. And that's the main reason many panic sellings happen near the bottom. Now let's bring this back to you and look at a critical question. What really happens in your mind during FUD? The first one is that you feel hurt. Losing money hurts more than making money feels good. So when the price drops, your brain just wants the pain to stop. Selling feels like relief. The second one is that what you see feels permanent. For instance, when the market is dropping, it feels like it will keep dropping forever. You forget that markets move in cycles. You fail to remember that prices don't move in one direction forever. When they fall, they eventually stabilize and bounce back. That's how markets have always behaved. No matter the news, no matter the situation, it will always recover. The third force is the people around you. When everyone is scared and talking about selling, fear spreads fast. It suddenly feels safer to follow the crowd, even when it's the worst time to do so. But for people who understand market cycles, dips look different. Instead of panic, they see opportunity. A dip opens the window for them to buy slowly, not all at once. This is where dollar cost averaging DCA comes in, buying little by little as the price drops to reduce your average buying price. In the stock market, many financial advisors say the same thing. Always be buying, especially during downturns. That's how long-term seven-figure portfolios are built, not by panic selling, but by staying consistent when others are afraid. And that's why, for most people, financial advisors often recommend starting your investment journey with ETFs. I have a detailed video on ETF, which you can check out. ETFs are like a basket full of fruits that you can buy with just one click. The basket represents the ETF, and each fruit inside represents a stock, such as Amazon, Apple, or Google. This means that with just one ETF, you own small portions of several stocks at once. So, if one stock underperforms, it doesn't destroy your entire investment, because the risk is spread across many holdings. So instead of going around researching which stock to invest in, you can just invest in an ETF that gives you a tiny bit of these stocks. The beauty of ETF investment is that it doesn't require much research. If you are in countries like the United States, you can start with broad market ETFs like VTI, SPY, QQQ, or dividend-paying ETFs like SCHD, VIG, and VYMI. The beauty of investing in dividend-paying ETFs is that they give you regular dividend payouts while your investment continues to grow over time. And while ETFs are commonly used in the stock market, the same disciplined approach applies in crypto as well. In the crypto market, analysts often recommend using DCA to lower your average buying cost and reduce emotional decision-making. For example, if you buy a coin at $50 and the price drops to $40, buying again at the lower price reduces your average cost. Instead of being stuck with a $50 entry, your average buying price moves closer to the current market price. This way, you're not trying to time the perfect bottom. You're simply staying consistent while the market moves. Now, let's look at the final point. What should you do when FUD shows up? First, you have to understand this. FUD doesn't show up at market tops. It shows up when uncertainty is highest. So instead of asking, should I sell right now? Ask yourself, am I reacting to fear or am I following a plan? You don't need to predict bottoms. You don't need to be fearless. You just need to stop making decisions under emotional pressure. This is about control over your emotions, control over your decisions. When the news suddenly feels urgent, when every headline sounds extreme, when fear, panic, or pressure feels intense, and when it feels like everyone suddenly agrees on what will happen next, that's not the time to act. That's the time to slow down. It's the time to study the market and look at the bigger picture. It is time to understand that markets move in cycles, and fear always feels loudest near the worst moments. Remember, the market doesn't reward the smartest people. It rewards the most patient ones. That's why long-term investors focus on simple systems, like using ETFs to stay diversified, using DCA to stay consistent during uncertainty, and letting compounding do the heavy lifting over time. Over time, within a few years, they are on their way to early retirement. Now you know why people panic and sell at the worst time, and what smart investors do differently. Remember, this video is not financial advice. It is only for educational purposes. Investing is risky and can wipe out your portfolio if you don't know what you are doing. Always do your research before investing, and do not invest what you cannot afford to lose. If you found the video helpful, like, share, and subscribe. Thank you.